Welcome to the TOEFL listening section. In this part, you will hear one or more conversations in an academic or campus context, such as a discussion between a student and a professor or between two students. You may take notes while listening. Listen to part of a conversation. You will hear it only once, so listen carefully. After the conversation, you will answer questions about what you heard. Some questions will ask you about main ideas and details. Others will ask about implied meaning, speaker attitude, or how ideas relate to one another. Use both what is stated and what is implied to answer.
Good afternoon, Dr. Morales. Thank you for meeting with me during your office hours. I wanted to discuss my project on climate risk modeling for insurance pricing.
Good afternoon, Marcus. I am glad you came in. Tell me briefly what angle you are taking on climate risk modeling for your actuarial project.
I want to build a model that captures extreme weather events like hurricanes, floods, and wildfires, and then use that to estimate premiums for property insurance in a coastal region.
That is a solid focus. You will need to be explicit about three components: hazard, vulnerability, and exposure, and then link them to an insurance pricing engine.
Could you explain what you mean by those three components in practice? I have seen those terms, but not in an integrated pricing context.
Of course, the hazard module describes the physical events, the frequency, intensity, and spatial distribution. For extreme events, you may use stochastic event sets generated from climate projections.
When you say stochastic event sets, do you mean something like a synthetic catalog of hurricanes created from downscaled climate model output?
Exactly. Synthetic catalogs let you overcome the short historical record and sample plausible rare events. They are often driven by ensemble climate projections and statistical downscaling.
And the vulnerability module relates hazard intensity to expected damage. Is that where vulnerability curves come in?
Yes. Vulnerability functions map hazard intensity, like wind speed or water depth, to fractional loss of a building. Value functions can be parametric or empirical and need calibration against claims data.
For exposure, we would include the insured values, locations, and construction types of properties correct, and we might account for changes like coastal development over time.
Correct exposure feeds into the loss module, and you must consider non-stationary exposure profiles. For long-term pricing, incorporate scenarios for population and asset migration into hazard zones.
I am trying to decide which statistical approach to use for extremes. I have read about generalized extreme value distributions and generalized Pareto distributions. Are those appropriate?
They are commonly used. For annual maxima, GEV is suitable, and for threshold exceedances, the GPD works well. But for spatially dependent extremes and compound events, you may need multivariate models or copulas.
Compound events sound important. Can you give an example of a compound event that matters for insurance pricing?
A good example is a hurricane that brings both extreme wind and storm surge at the same time, or a drought that increases wildfire risk followed by high winds. Those combinations can produce losses that are larger than the sum of individual hazards.
How should I handle uncertainty from climate model projections when estimating premiums? Should I produce a single scenario or a range of outcomes?
You should present a range. Uncertainty arises from climate scenario, uncertainty model, structural uncertainty, and parameter estimation. Uncertainty affects expected losses and tail risk, which in turn changes risk margins.
So higher uncertainty leads to higher risk margins, which would increase premiums or capital requirements for insurers.
Precisely. Actuaries price both the expected loss and a load for uncertainty and capital costs. For extreme weather, the tail of the loss distribution often dominates pricing decisions for large policies.
What about model calibration? If I use synthetic catalogs and vulnerability curves, how do I ensure the model is realistic?
Calibration is crucial. Compare model outputs to observed loss histories where available. Use backtesting and goodness of fit tests. Adjust parameters and apply bias correction to climate model inputs. If historical records are sparse, use expert judgment and conservative assumptions.
In terms of reinsurance, how do climate projections change the way insurers purchase reinsurance?
Climate projections can alter the expected frequency of exceedance for attachment points. Reinsurers and cedents may shift layers and pricing if projected tail risk increases. For example, a 1 in 100-year event under historical climate may become more frequent under future scenarios.
Do actuaries use scenario analysis to communicate these changes to stakeholders and regulators?
Yes, scenario analysis with well-documented assumptions is standard. You would present central estimates and stress scenarios. For regulatory capital, demonstrate resilience under adverse climate trajectories.
Can I incorporate mitigation and adaptation actions in the model, like flood defenses or building retrofits?
You should. They change vulnerability and exposure. Over time, they can reduce expected losses, so premium trajectories differ if adaptation is implemented. Capture mitigation costs and timing to assess cost-benefit for policyholders and insurers.
I want to include a case study. Do you think a Gulf Coast hurricane risk study with changing sea surface temperatures would be appropriate?
Yes. That is appropriate and relevant. Use ensemble sea surface temperature projections to alter storm genesis and intensity modules. Calibrate to recent landfall losses, and then project changes in return periods and premium impacts.
For my deliverable, I plan to show expected annual loss premium scenarios and tail risk measures like value at risk and tail value at risk. Does that sound right for an actuarial audience?
Absolutely include expected annual loss, premium, and exceedance probability curves. Also show sensitivity analysis to key parameters and transparent documentation of assumptions that will make your results useful for pricing and capital planning.
Thank you, Dr. Morales. This helps a lot. I will start assembling hazard catalogs, vulnerability curves, and an exposure database, and then run stochastic simulations.
Good plan, Marcus. Remember to document uncertainty sources and to justify any bias corrections. And if you like, I can review your first results before the final submission.
I would appreciate that. I will send you an initial report in 2 weeks and include a case study on Gulf Coast hurricane risks and a sensitivity analysis for adaptation measures.
Great. I look forward to it. Good luck with building the climate risk model, and remember to think about extreme tails, not just averages.
Listen again to part of the conversation, then answer the question.
When we build a climate risk model for insurance pricing, we combine a hazard module, a vulnerability module, and an exposure module, and then simulate loss distributions.
This concludes the conversation portion. For more TOEFL practice tests and study materials, visit Spinta.org.